what's popularly referred to as BRRRR, which is B with 3 R's, otherwise known as buy, rehab, rent, and refinance. And that we see...
Well, they actually added a 4th R to that, and repeat. because the thing is, like, once you refinance, you have the money to start over. So
That's true. That's true. Repetition is very important with this strategy.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
Episode 10.
hello, and welcome to the next episode of the Old Fashioned Real Estate Show. My name is Jeffrey Holst.
I was going to say he's Jeffrey Holst and I'm Brian Leverage.
Oh,
He already beat us to it, though, so that's okay. Pleased to be back with you again today. Today's topic is going to be a discussion about some alternative or creative methods to controlling real estate. Recently, we talked about financing and leverage in terms of it being able to help you and hurt you in controlling or acquiring properties. And today we're going to explore a couple other options besides your traditional lender financing. First one we want to get into is very similar to the bank, except the property seller is going to actually act as the bank. This works in situations where there's the property is owned free and clear, and the seller can act as the lender. So you would give them some type of a down payment. You can negotiate 100% of the term, right?
Yeah, typically. So this is something, it's often referred to as like owner financing or seller financing. In some states, they call them land contracts, but the basic idea is the same.
Yeah.
So a person has a piece of property that they want to sell, and they maybe don't want to recognize all of the gains that they get from it in the initial sale, and they can kind of stretch the gains out over time by taking payments on it.
Yeah. So, some of the advantages to this are, unlike a bank, pretty much 100% or almost all of the moving pieces in this type of a deal are negotiable. You can negotiate the interest rate. You can negotiate the down payment and the term. It can be longer, it can be shorter. And while you can, to some extent, negotiate that with your average portfolio bank or community bank, there's really, the term is going to be the term with them. Interest rate, you might have a little bit of flexibility and generally a lot less flexibility on how much you have to put down.
Right. And there are a number of compelling reasons why, as an investor, you might be interested in seller financing. Well, other than just the terms, but you might also be looking at a situation where you've already borrowed a bunch of money from a bank, and banks are getting a little bit more tight, and the sellers might be more willing to do it, or they might give you longer terms than what the bank would do. There's a myriad of reasons why this can be really useful, and sometimes you can have very low down payments.
Yeah.
It just depends on how motivated the seller is.
Sure, and if you have limited capital with which to invest in the first place, or recent job history, or say even your credit's not so great, your typical seller finance deal, they're not really running your credit, and it gives you an additional opportunity to invest.
Right, and if you're like Brian and I, and you work for ourselves, sometimes, especially when you first start working for yourself, banks are way less flexible.
Yeah, exactly. Probably one of the biggest advantages is that once you've actually negotiated the term and you've started making payments, you've converted their property into a stream of payments. So they don't have any emotional attachment to it down the line. So potentially after a few years, if they've been getting a couple $100, maybe $1,000, really depends on the size of the note and the property, etc., you can actually approach them and negotiate a lump sum payment, which,
right. And this is something that I think both of us have done in the past, where we've negotiated seller financing and we've paid them for a year or two, and then we've gone to them and say, hey, the balance is $50,000, but why don't we give you $45,000 or $30,000
or 30 or whatever
it might be.
And your return goes up substantially in those instances.
That's exactly right. And people's situations may have changed, and they may have decided that they want the cash at that point.
Yeah. So another option that is less discussed is what's called a master lease option. And what that is similar to is it's almost like test driving a car. You go to the dealership, you're thinking about buying the car, but before you buy it, you want to drive it around the block a couple of times and test it out.
Right. So basically what a master lease option is it's, if you dissect the words, you can almost figure it out. But it's basically getting a lease for a piece of property that also includes an option to buy at a fixed price. So you might look at a duplex, let's say, and it's maybe the seller's saying, "Hey, I want 120,000 for it," and you're looking at it and going, "I don't know if I want to put 20% down right now." So you make some kind of option payment as part of the lease, and that might be a few $1,000s, and then you lease it from them, and you lease the whole duplex, and then you can continue to take over the property. You can lease out the two sides, you can raise the rents, do whatever capital improvements you need to, and then at some point in the future you have the right to buy it for 120, and it doesn't matter if the property went to 150, 200,000, you can still buy it for 120 during that lease period.
That's right. They're obligated to sell it to you as long as you exercise your option during the option period.
That's right.
And another advantage on that note is that you want to especially try to use this strategy in situations where you've identified the property owner has his rents too low. So you can go, on Jeff's duplex example, say the rents were $500 a side, that's $1,000 a month. You say, I'll guarantee you the $1,000 a month. You're still going to pay the maintenance like you would anyway. But say the market rents were $800 per side. You've got that $1,600 now coming in, which is going to give you a spread. You're almost arbitraging someone else's money to do this deal.
That's right, and you can get a really great return because you might have only paid them $1,000 plus the $1,000 a month, and now you're making $500 a month on a $1,000 investment, which is pretty attractive.
Yeah. And if, on the other hand, the property doesn't perform to your expectations, say the vacancies last longer, or maybe it's an older property and the maintenance ends up being too much and it's eating into your returns, you only have your option money at stake that you lose. And if you've structured the deal properly, you want to try to structure it so that what you'll receive in income during the option period is in excess of the option money itself. You can essentially get out of it with really what boils down to your time having been invested.
That's right. And oftentimes you can even put into the contract an option to walk away from it early and not even have to hold it for the whole option period.
Yeah. So we've covered that one. Another one is what's popularly referred to as BRRRR, which is B with 3 R's, otherwise known as buy, rehab, rent, and refinance. And that we see...
Well, they actually added a 4th R to that, and repeat. because the thing is, like, once you refinance, you have the money to start over. So
That's true. That's true. Repetition is very important with this strategy. The point to it, though, is that you can get into a property generally with very little out of pocket once you've gone through the entire cycle. But you have to be able to refinance.
Yeah, so the general idea is you buy a piece of property either for cash or with hard money, and then you rehab it to raise its value. Then you go and refinance that property. And if in an ideal situation, you can pull out all of your money. Oftentimes the bank will want you to leave some of that money in. And then once you've done that, you're able to go ahead and use that initial money again to buy the next property.
Kind of an important note that Jeff touched on. Lenders have sort of become a lot more aware of this strategy, and we've been in a longer real estate expansion for a while now. And so lenders are a little more hesitant to refinance 100% of your basis back to you in those situations. They want you to have some skin in the game, as we say.
Right, and just for clarity, if we were talking about like a single family house that costs $100,000 to buy and it was going to be worth $200,000 rehab, if you put like $50,000 into it, now you have $150,000 into it. In the past, banks would look at that and go, hey, it's worth $200,000, we'll give you a 75% loan to value, you can have your whole $150,000 back. Now a lot of banks are saying, no, we want you to leave 10% in or something like that.
Exactly.
So you might get $135,000 of your $150,000 back. But you still have a property that's worth $200,000 with substantial equity in it.
And even if you're leaving 10% in on every deal, that strategy does allow you to do additional
10 times
deals.
as many deals, right?
And it's your traditional 20% down at the outset type
for
purchase.
sure, at least, and potentially double or triple the number of deals because you're getting the equity build during the process.
Exactly. The last one, which is almost part of the BRRRR strategy, is hard money. And hard money is essentially, there are institutions or groups of people, or private individuals for that matter, that will lend to you on a private basis. So they're looking more at the value of the deal. why don't you tell us how that works a little bit?
Yeah, so typically with a hard money lender, they'll look at the deal, they'll look at maybe your experience, they're going to want to be comfortable with you as an operator, and they'll lend up to 100% of the project price. So this is really good if you're doing like a buy and rehab situation like the BRRRR strategy, because you can look at it and say, hey, it's going to be $150,000. Where if you were to try to borrow $150,000 from a bank, that'd be very difficult on a property that is objectively worth 100 at the time you're buying it.
Yeah.
But the hard money lender will say, hey, we know that you as an operator are going to turn this into a $200,000 asset, so we'll loan you the whole $150,000.
And they'll generally order their own appraisal anyway, and so they'll kind of figure out what the thing's worth on the front end and what it's worth on the back end, and their risk analysis will include looking at both of those and determining just how much they'll lend to you, which in some instances, if you're buying it far enough below market, will be 100% financing on both acquisition and your renovation costs.
That's
and
right.
That's pretty huge, because that means you don't need to have as much money to put into a particular deal. You just have to have enough to cover the points that they charge, which are generally, 2 points is about the low end of what they charge of the total value of the deal. And then the interest costs probably are anywhere from 10 to 12% at the low end, and they go up from there. And that's interest only on a monthly basis.
Right, and that stuff is completely negotiable with your hard money lender, because one thing to remember is most hard money lenders are just individuals that have some money that they want to lend. If Brian had some money sitting around and I was like, hey, Brian, I need to buy this property, he might go through that process with me and charge me like 50% on my money and
or
20,
maybe send
25
you down the
points.
road.
Yeah. But the point is that this stuff is much more flexible than traditional bank lending.
Yeah.
And kind of related to hard money, there's the possibility of like just private money in general, which the difference between private money and hard money is private money is typically a longer term investment of capital. So you might be able to negotiate, it's kind of related to seller financing, but it would be almost like if I have a duplex and Brian has some money and someone else wants to buy my duplex, I might say, hey, I don't want to seller finance it to you. But Brian might say, you know what, if you give me 6 or 8% on my money, I'm happy with that.
Yeah.
And then he would take a mortgage on the property and act as the bank.
That's a great point. The interest rate will generally be in excess of what you could get at a traditional bank or FDIC institution. And the investor's making more money, and
right, but you're as an investor able to get into a deal that you wouldn't be able to, and the lender, who's also an investor in that scenario, is able to get a better return than they would get by putting it in a bank.
The important thing with utilizing either a private money loan or a hard money loan, depending on the situation, is that you need to always make sure that you have a clear exit out of that. It's one thing if you're just buying a property to rehab it and try and flip it out, but you should also take a look at, well, what happens if it doesn't sell? And you need to make sure that you have a takeout lender lined up to refinance you, because hard money loans, while they can be cost effective on the front end, the longer you hold them, the less so that
if you're paying 12% or more in interest, it can be very expensive. Additionally, a lot of hard money lenders will not go longer than a year or 18 months. And so if you get to the end of that period, you could literally lose all of the product of your work. They'll just take the property back and sell it themselves or rent it out or whatever they want to do.
Well, that's all we're going to cover on this topic for today. I just wanted to give you guys a couple different options to think about as you are looking to expand your investing arsenal, and we look forward to seeing you again. Thanks so much.
Yeah, and one quick side note, sorry to continue there, but postscript here. If you want to talk about any of these issues that we talk about in our shows, please reach out to us on our website, and we'd be happy to discuss that. We'll even schedule a call with you and have a conversation about any of these topics.
Happy to do so. Now it's goodbye for real. See you next time.
Thanks.